Hello, this is Jim Bell, President and Founder of Bell Investment Advisors. I'm joined today by Corinne Salera, Investment Advisor here on our team. And we're happy to be presenting our webinar on how to make your life work financially. We're very happy that you joined us. We have a lot of ground to cover, so we're going to jump right in. You do have the ability to submit questions. We probably won't have time to answer those live today, but we will capture them, and I promise you someone will get back to you with good answers to those. If you're having any trouble with your audio or visual, please call our office at 800-700-0089, 800-700-0089, and somebody will be on the other end of the phone to help you. So, moving right along, how to make your life work financially. My first point is that we've always believed here at Bell Investment Advisor that your career is your chief financial asset. And I just recently looked up career and discovered that when it first appeared in the English language, it meant the same thing as a road. So career is a road. It's a path of our life. And retirement, in terms of a road, retirement can be a career. And here at Bell Investment Advisors, we've always believed that everybody should have the opportunity to work with a high level of passion and energy. So we have the skill set on staff here through my wife, Bonnie Bell, who has a process for helping people discover and live with passion and energy regardless of what they're doing, whether their road that they're on is retirement or early career. Bonnie's helped many children and grandchildren of our clients find their way in the world and work and live with passion and energy. So once you get your career, your passion and your energy lined up, the financial benefits usually follow. And we're great at helping people make that happen as well. Second point, making your life work is not a contest. We're going to be talking a lot today about your specific situation and what do you need to make your life work. What we encounter a lot is that people, it's easy for us to become competitive when your neighbor brags about all the money they made in Apple stock or what their managed future strategy, how they made 40% last year or something like that. That's fine, but what we're emphasizing here and today is that what's the required rate of return, what's the appropriate amount of risk for you to make your life work. So it's not a contest. And the third point is a portfolio strategy not sourced by a financial plan is just whistling in the wind. And what I mean by that is that what financial planning does for you, and we believe it's very important here, is specify, looking at your whole picture, your whole financial landscape, what's the least amount of risk you can take or we can help you take to give you the cash flow to make your life work. So you're kind of competing with yourself. You're not competing with your neighbor or your friends. It's about you and your life. So on this next slide, I'm showing the final result of a fully developed financial plan for a couple. We've changed their names to protect the innocent, so this is a plan for Bob and Joan. But it's based on their whole picture in terms of all of the assets that they have that generate cash flow. Some assets in your net worth don't count to generate cash flow, like your personal residence. Unless you're renting out rooms or something, that's an asset, but it doesn't help the financial plan. It doesn't generate cash flow. So we look at everything. There's Social Security benefits. When should they take Social Security? Are they eligible for a spousal benefit, which Corinne will talk about soon? What are their obligations? Is it their ambition to educate their grandchildren, or are they done educating their children? What are their living expenses? What's their ambition for vacations? How much do they want to budget for vacations? And what is their charitable plan? What is their charitable intent? How much do they want to budget for gifts to charity? So taking all that into account and identifying the optimal strategy from a risk-returns point of view, you can see this plan. If you look at that box on the right side, the final result, it has a probability of success rated at 93%. So that's a very strong plan. And next I'm going to show you the next slide, which is the same couple, the same plan, and they decided that they would like to explore the possibility of buying a vacation home with an ocean view on the Atlantic coast. So we worked with them. They did some research. They went and looked at possibilities. They gave us their budget. We decided what they would optimally pay as a down payment and what the estimate the cost of the mortgage and upkeep of the home. So we factored that variable into the plan, and you can see what happened here. The probability of success dropped from 93% down to 76%. So I wanted to show you this because it's a great example of the very meaningful conversations we can have with people about the consequences of what they're thinking and what they're planning to do possibly. But it's very helpful to ground these kinds of choices and decisions in actual probability analysis to make sure that it's not going to upset other factors. So we continue to work with them on different strategies for how they might make this happen. The variables can be extended. It could be that they'll need to work longer or work part-time longer. There's lots of ways to look at this, but we're very proud of being able to ground what's coming up for them. So here I want to talk about, again, that financial planning helps specify a required rate of return and an appropriate portfolio strategy. And here at Bell, we have a range of possibilities in terms of portfolio design and construction. We have a very effective cash reserves management system. We recommend to people who are fully retired that having 2 years of living expenses in a cash reserve account, where we've been able to average just over 4% net returns for the past 5 years, I believe. We also have a stable growth strategy, which is minimal risk, and we customize all these strategies to the particular client and what's their required rate of return and what's the optimal amount of risk in their portfolio. More clients are coming to us who want low expense, tax efficient index strategies. So we are experts in designing all types of portfolios. So that's another offer that we make here if that's important to you, if that's a value for you. The next point about values investing, there's many ways to take care of your concerns and express yourself in terms of investing in ways that are very supportive of environmental concerns that might address global warming. Also, it's possible now to invest in portfolios that are very favorable towards women. Goldman Sachs has done a study of corporations that have a high level of leadership in their executive suites and on the board that includes women at above average populations. And those companies, according to Goldman Sachs, are outperforming the stock market by 25%. So there's an important argument there for expressing that value and actualizing it in an investment portfolio. Our full-on growth strategy we call active portfolio enhancement, and we'll be showing you some examples of that. But the final point is don't take any more risk than you need to make your life work. That's a very important principle. In a minute, Corinne's going to talk about cash flow versus income. And the first point here is about longevity risk once you reach age 65. You may not know it, but demographically, once you reach age 65, and if you're married, at least one party is going to live well into their 90s. That's just statistically true. So the retirement period in life is expanding quite dramatically. And Corinne will explain in a minute. Just going back to that title, longevity risk, it's kind of ironic that we would think of longevity as a risk. We would think it would be a good thing, and it is a good thing, but it's also ambitious to fund a retirement that might be 30, 40 years without a paycheck, which is not uncommon today. We use a growth and income strategy to produce tax-efficient cash flow. And again, I'm going to come back to this required return calculator that we've developed here to optimize what you need to make your life work. So Corinne, please come in here and talk to us about real return and what this portfolio says about possibilities and the 4% rule.
Sure. Thank you for that great introduction, Jim. As you see here, the title of this slide is What is Real Return? And there's quite a bit here, so let me take the time to orient you. The top section details the holdings of this particular client, the since month returns, as well as the since purchase returns. That's all at the top there. The year-to-date section in the middle details the outflows and inflows to the account, as well as the year-to-date return. And finally, the historical returns are at the bottom there. This client has returned over 815% since October 11th, 1991. That, if you're wondering, is a 10% net of fees annualized return. That net of fees return is important, but perhaps not the most important figure. The real return is what we're after, and real return is adjusted for inflation. The current inflation rate is actually running quite low, 1.3% including food and energy, 1.7% excluding those items. Historically, the rate's quite a bit higher. In financial plans, we use a 3.1% rate, which is the historical average over the last 100 years. If your money's invested in bank accounts or low-yielding CDs at the moment, likely your purchasing power is being diminished because you cannot exceed the rate of inflation. For our purposes, I like to return back to the middle of the statement to show or point out that this client withdrew $140,000 for the year. And to Jim's point, this was not created solely on dividend or income from the funds. It was a combination of dividends, growth of the assets, and also being strategic about where to sell from. If a portfolio creates an unrealized loss, likely, or there are times when it can be very useful to realize those losses to offset gains that have either already been realized or could be realized later on in the year. And my final point for this slide is downside risk. We spend a lot of time speaking about downside risk and a client's particular risk tolerance. And this client is taking less risk than the market as a whole, but still is utilizing our growth-oriented strategy or active portfolio enhancement, as Jim referenced earlier. This next client has a different story. We went through a financial plan with this client, and the financial planning results were actually quite strong. The strategy that you see here is stable growth, which is our more conservative strategy. And the reason that this client is utilizing this strategy now is because the financial planning results were quite strong, the strongest results actually occurring with this stable growth strategy. And so we adjusted their retirement accounts, the client and his wife, we adjusted their retirement accounts immediately, but waited to adjust their taxable account until their tax rate reduced this year. So that's all been done now. And as Jim mentioned earlier, we never want anyone to take more risk than they need to. And we thought this was a great example of making your life work, supporting your goals, but minimizing risk. And really, without a financial plan, this knowledge wouldn't have existed. Moving on to the next slide, we've talked quite a bit about cash flow, but less so about withdrawal rates. This graph here walks us through the 4% rule. Michael Kitces, who's a renowned financial planner, writes a lot of literature about the 4% rule, which essentially says that upon retirement, you should be able to withdraw 4% of your portfolio balance annually for 30 years with the confidence you will not run out of money. The research in this graph, let me just walk you through it. The retirement year is on the x-axis and the historical safe withdrawal rate on the y-axis. The research assumes a 60-40 portfolio, 60% equity, 40% bonds, and the 4% rule comes from not taking the average of these different time intervals, but taking the worst case scenario. So even if you retired at the worst possible time, you should be able to withdraw 4% of your portfolio per year without running out of money. I'd like to hand it back over to you, Jim, now to discuss good saving behaviors.
Thanks, Corinne. So if you're still working, or if you have children who are working, an important saving behavior is to maximize the deferrals that are available to you through your occupation. This year, if you're eligible to participate in a 401k plan, you can defer as much as $18,000. Mm-hmm. And if you're 50 years or older, you can add another $6,000 on. Is that right?
That's right.
So $24,000 if you're over 50, $18,000 if you're under 50. But we've always counseled our clients, young and old, to default to doing the maximum in terms of deferrals. And if it's not possible to do the maximum, then it's always prudent to save at least 10% of your net income, even outside of retirement plans. And that principle about paying yourself first, which is what makes 401k structures ideal, because it's automatically deducted out of your paycheck. You don't even see it. It's a great structure for paying yourself first. If you wait till the end of the month to see what's left in your checking account, that's probably not going to work nearly as well. And the final point here is that it's really important to take appropriate risk. And there's ways to take too much risk. There's also it's also possible to take too little risk. As Corinne was talking about real return in terms of protecting the purchasing power of your dollars to stay ahead of inflation, you can't do that in a risk-free portfolio. So again, that's one of the ideal benefits of financial planning, is optimizing that risk profile for you. So here I want to make the point about global diversification and demographics. Currently, the United States only contributes 22% to the world economic output. So we're not 50% anymore. We're 22%. So if you want to participate truly in the global economy and be globally diversified, which is certainly an important aspect of the optimal portfolio, one of the drivers that we look at are demographic statistics. And it's from an economic point of view, demographics are one of the strongest future economic indicators or economic engines of production. So the younger the median age of a population in any given country, the greater potential and opportunity they have for economic growth in the future. So you can see the median age in Brazil is 29, in India it's 26. Japan, as I'm sure you've heard, has a problem in that their median age is 45. Germany's not far behind at 44, and the United Kingdom's at 40. Fortunately, in the United States, we're at 37, which is getting a little toppy. And honestly, immigration policies help. Our immigration policies, which we encourage, actually help keep our median age down in the 30s, which is very important for economic future. In terms of appropriate risk, I wanted to show the power of stock market allocation, and this is a 100-year study taking $1 each investment back in 1900 in gold, U.S. government bonds, S&P 500 stocks with dividends, and the consumer price index. And you can see why there's so much emphasis on the stock market. That dollar in that century grew to over $16,000, whereas everything else is in double digits. In 100 years, the value of gold only increased 13 times. U.S. government bonds, a dollar grew to $93, and the consumer price index, or inflation, was $23. So this is why the stock market is so important in cash flow generation and retirement planning. Final point on this slide is that there's been numerous studies that show the less frequently people look at their accounts, and many people look at them every day or many times a day, that practice is not very productive in terms of generating future returns. It makes people too anxious and they make emotional decisions. So here's a recommendation to look at your statements quarterly or less even. So Corinne's now going to talk about 10-year time periods in terms of what investment results can look like over 10-year increments.
Yes, thank you, Jim. So moving to another recommendation we have, it's to base decision based on this perspective, the one you see on your screen. This chart is detailing the annualized returns of the MSCI World Index over 10-year rolling periods. It really helps to smooth out the ride, and this is how we would encourage investors to make decisions. As you can see here, almost every 10-year rolling period is above zero or in positive territory. As many of you know, investing takes patience, and we really think this is the way to make decisions and build strategies. It should be based on long-term results. But unfortunately, that's not the case. That's not how many of us make decisions, but rather the yearly market turmoil governs our decisions. And as you can see here, the gray line on top of the blue line is detailing the annual returns of the same index, and it tells a harsher, much more volatile story. And again, this is how most investors make decisions. They make emotional decisions based on the short-term performance of the market, and it can be really punishing and rob investors of much-needed return. The next slide demonstrates just how punishing this can be. The following was pulled directly from Dalbar's annual quantitative analysis of investor behavior report, and I'm just going to go ahead and read it out loud to you. Investment results are more dependent on investor behavior than on fund performance. Mutual fund investors who hold on to their investments have been much more successful than those who try to time the market. The average 20-year return for the S&P 500 between 1994 to 2013 is 9.22% annualized, while the average equity fund investor return for the same period is only 5.02%. That's a gap of 4.20%. And this loss of opportunity is largely due to the market timing behavior of investors. That 4.2% gap, that return on $1 million for 20 years, is equivalent to over $2 million. We really think this misreturn is alarming. If you're a more visual person, we want to show you the data in graph form, and here it is. The last two bars show the 20-year stat I just went over, 9.22% for the S&P 500 versus 5.02% for the average equity investor. The annualized long-term returns shown in other years tell a similar story, if not more drastic. As you can see, You know, the 1999 chart, really the green bar is over double the red or that of the return of the average equity fund investor. So in summary, we think these results are staggering and really show the importance of avoiding making emotional decisions and timing in and out of the market. Jim, I'd like to hand it back over to you to move us through investment management strategies.
Thank you, Corinne. A friend of ours is named Tim McCarthy, and he's the former CEO of Charles Schwab and Company. And he just published a book, I believe it was in, I don't know if it was last year or 2013. It's called The Safe Investor. It's a very good book. We recommend it highly. And Tim gave us permission to use his illustration here about the three pockets. So what this is referring to is that, as I indicated earlier, we think it's really can be very helpful for investors and clients to have significant cash reserves. So if you're still working, 6 months of living expenses is a good number to orient around. If you're fully retired, if you have no more income from work, we do recommend having two years of living expenses in a cash reserve strategy like ours. So that's the pocket on the left side. The middle pocket is the investing pocket. And this is what we've been talking about mostly today, is the core investment that's going to generate the cash flow in tax efficient and optimal ways in terms of risk and return. So that's going to be the larger pocket, and the size of these pockets is just for illustration. They could vary depending on individual circumstances. I mentioned earlier about your neighbor who maybe made a killing in Apple stock, and for many clients it's important that they have a trading account. They enjoy it. It really activates their mind. They like to do the research. So in terms of satisfying the whole person, these three pockets can play a significant role. And the main thing is that your core investing pocket, that's the one that really drives your life and takes care of you financially. The trading pocket might be icing on the cake, where you get to exercise your financial acumen and experiment with things in a way that might be a hobby, or certainly generate passion and energy. Next, I want to talk about risk classes. I know Corinne already referred to this. We specialize in no-load mutual funds and exchange-traded funds here at Bell to generate returns and cash flow. We have 5 different classes of risk, and as Corinne indicated, we think it's very important for clients to understand what the maximum downside or worst-case scenario might be in any portfolio or class of investment. So we know that in the 2008-2009 financial collapse, that our very speculative, non-diversified Class 1 funds fell as much as 56%, whereas if we come down to Class 4, which are balanced funds, combinations of stocks and bonds for the most part, or growth and income, the maximum downside there in that worst case was 25%. And in the fixed income accounts, the Class 5, we're really looking at a maximum of 5 to 10% downside in a very devastating situation. So educating clients about risk is very important to us. And again, targeting your ideal risk and return profile is very important to us as financial planners. I mentioned earlier that we have clients coming to us who value an index strategy, very low expense funds, and tax efficient growth, meaning that the degree of activity is quite restrained. So we've been able to design a portfolio such as this to actualize an index strategy, and as you can see, it's much more complicated than just investing in the Vanguard S&P 500 fund, for example. The Vanguard S&P 500 is all U.S. large cap stocks. That's really only one asset class that's available to you. So it wouldn't be very diversified, and it would have significant downside risk. Here we've taken a client that wanted an index strategy, but we've really diversified it across different capitalizations. We have some small cap exposure, some international exposure. So we just wanted to give you an example of that. This is a very conservative client, wanted a 50-50 portfolio, meaning 50% in bonds, 50% in fixed income. So we also built out the 50% side of the portfolio that's all bonds and fixed income. And again, you can see it's a fairly elegant and appropriately complicated and diversified strategy we have here. And the average expense ratio is only 0.32, 32 basis points. Now Corinne's going to talk about the benefits of Social Security analysis, the spousal benefit, and the 8% guarantee that's available in some circumstances with Social Security.
Mm-hmm. Thank you, Jim. We've already touched on one of the major benefits of having a financial plan, and that is it can give guidance to the optimal strategy to support your goals. But there are other benefits and other offers within financial planning, one of which is a Social Security analysis. We actually have an entire webinar on the topic, so if you are looking for more information, I would encourage you to find that on our website. But essentially the goal of a Social Security analysis is to ensure that you or you and your spouse are receiving the greatest possible benefit. Sometimes this involves delaying your benefit and receiving that 8% per year guarantee. Other times it means taking advantage of spousal benefits, which allows one spouse to take a spousal benefit while allowing each individual benefit to grow at that 8% rate. So you take the spousal benefit and it doesn't affect either individual benefit. Again, I would encourage you to review your options and get more information either from your financial planner or looking to that webinar, which is quite robust. Jim, I'd like to hand it back over to you to discuss long-term care and the other benefits of financial planning.
Thank you. So most of you, I'm sure, have heard of long-term care insurance. Some of you may even have policies. This is a concern that many clients come to us about in terms of determining should they not, what kind of policies. We've developed a very strong network from a fiduciary standpoint about professionals that we work with that provide long-term care insurance. So we can help you think through that. Some of you might be self-insured. You may have enough assets that you don't need long-term care insurance. Others, it might be very relevant and helpful. So that's something that we help many people with. The big answer that we provide for clients in regard to financial planning is how long do they need to work, or how long should they work to make their life work financially. So we've been able to answer that for many, many clients, and it's brought them a high-level peace of mind, and they now have a path to their life goals in terms of what they want their future to look like. As I've shown before, we do calculate the probability of success in financial planning, and that's also a generator of peace of mind. And the final point here is that we facilitate flexibility. And Corinne and I were just talking about this. Sometimes we need to be flexible in generating more cash flow for a client that might be above the 4% line. And sometimes clients need to look at their discretionary spending. When we help people do their spending plan or their budgets, there's most of us have fixed expenses, our core expenses, but we also have discretionary expenses in terms of the types of vacations that we have, the amount of generosity we can provide for grandchildren. These are conversations that we have all the time, And so flexibility being part of the conversation. Some years you may have to cut back a bit in terms of your gifting or your expensive vacations to keep your plan on track. And we keep plans alive and current, and that way they really do provide powerful possibilities. On this next slide here, we've done lots of research into reverse mortgages. Again, we found fiduciary providers of this kind of product. It's still a rare option. It certainly isn't common. It's not going to fit many situations, but it's important to know about, and it's important in situations where it might apply. It might be the ideal answer for parents or grandparents so they can stay in their home. So we can help you consider that as well. We really encourage people or our clients to complete their estate plan and living trust. And one of the ways I look at this in terms of your completing your trust is that it's a tremendous gift to your survivors. All of us are going to die, and somebody's going to have to finalize and clean up our lives. If you've done your estate plan and you've developed your appropriate trusts, and we have great referrals in this regard, you're doing a great favor to your survivors, your children, your spouse. You don't want them in anxiety after you're gone with the complaint that they wished you had done your homework and helped out a little bit. It's an adult responsibility that we all have. Final 2 points here on this slide are that it's very important how you title assets. So if you're married and you're holding assets in joint tenancy, when the first party dies, the survivor is only going to get 1/2 step up in basis. If you're holding those same assets in a living trust or titled as community property, the survivor will get full step up in basis. All the embedded capital gains tax will be forgiven. So this is a very important point. What we recommend is that because of that step up provision, if you've titled your assets properly in your estate plan, it makes sense to gift those positions outside of retirement plans to individuals. And the final point here about retirement plans is that your rollover IRA, your 401k plan, your defined benefit plan, that really can't escape tax even after you're gone. So our recommendation is that in the retirement plans, in your rollover IRAs, there's a prime opportunity to name charities for those benefits, because the charities aren't going to pay tax on those gifts, whereas your children and survivors will end up paying tax, even though they might be able to stretch that out. So we, as fiduciaries here at Bell Investment Advisors, we certainly promote the idea of having a third-party custodian, that your assets are not captured or held by the same investment manager or broker. We think that third-party distance is very important. It's a very important protection for all parties. We do get quite a few questions about annuities. Again, we don't think they apply to as many situations as we see them popping up, but many people come to us for analysis of annuities. Should they take the annuity as a retirement benefit? One of the points that Tim McCarthy makes in his book, The Safe Investor, is the theory of trickle in and trickle out. And as I referred to earlier, if you're taking advantage of paying yourself first and maximizing your deferrals, you're constantly pouring money into your asset pool. And then once you reach a point in your life where you need to take cash flow from that pool, it can trickle out. And so this trickle in, trickle out philosophy of life, as silly as it might sound, is quite powerful. And the final point that we'll make before we close is that many people come to us with the concern about family succession planning. And in many respects, that means taking care of your spouse. Often in a relationship, one spouse is more financially active or proficient than the other spouse. So it's usually, one spouse takes care of the money, the finance, the investing, and the other spouse leaves it alone. Particularly in financial planning, we work very hard to get both spouses involved. We think that's very important. But a lot of people come to us to start a relationship because they want their surviving spouse to know who the advisor is and to know who they can turn to when the first spouse dies. And also, in terms of financial planning, financial succession planning, at the request of many of our clients, we're helping their children get started, learning about investments, learning some of these behaviors, helping them qualify for a mortgage. It covers quite a range of generations. So this wraps up our presentation today. We're very happy that you joined us. Please send those questions in. As I said, we'll make sure that we answer them. Our next webinar is going to be on February 25th. It's for clients only. It's our investment committee update that we do every quarter. There's many ways to stay in contact with us. Here's our 800 number and our info address at bellinvest.com. And we invite you to keep in touch with our website, follow us on Twitter, LinkedIn. We do a career and life coaching blog by Bonnie Bell. We also do a finance blog by various advisors here. And there you have all our contact information. So, Corinne, thanks for contributing today and helping out.
Of course.
And we look forward to hearing from you in the future.
Thank you.